Welcome back to Strongman Personal Finance. What we have here is a well thought out, highly researched, ingenious video from one of the greatest investors of all time, Paul Samuel Sam Wayne Gabriel. We're going to react to, if I had to choose one ETF, it's this. Because I thought Everything Money was, a good channel. They have 260,000 subscribers. And as a stock picking channel, they seem to give great stock recommendations, and they've actually made me a lot of money. And I appreciate them for that. Thank you. They've inspired me to pick stocks as well. But I'm a little concerned about this ETF that they're shilling. So let's go ahead and react to this video, and I'm going to highlight some very, very, very critical flaws in an otherwise intelligent man's thought process. Let's go.
Guys, there is an ETF that can beat both SPY and VOO over long periods of time. And I'm going to show you why you may want to look at this one to add it to your portfolio. Now,
literally any ETF ever conceived could potentially beat VOO in the future. You don't know the future. I mean, the Treasury ETF could beat it. ARK could beat it. Literally anything has a possibility of beating VOO over long periods of time into the future. If you identify one ETF that does this, you're just pulling numbers out of your rectum.
People who've watched this channel know that I'm a big believer in SPY or VOO. This is SPY. Net expense ratio, 0.09%. Dividend yield, 1.23. But the real reason is, over time, the market's going to go like this. But
you don't know that. But the funny thing is for SPY, so if you want to invest in the S&P 500, there are better options than SPY. The SPY has a 0.09% expense ratio. VOO is like a third of the cost. It has a 0.03% expense ratio. I mean, we're looking at dollars here. But if you had two ETFs that had the same exact metrics and you wanted to invest in it over 30 years, would you buy the one that has 0.09 or would you buy the one that has 0.03 expense ratio? SPY is for traders, clowns, basically. Okay, but that's besides the point. Let's keep listening.
the price is going to go like this. So the best way to get the market return is dollar cost average. And I always say a low cost market-based ETF. But lately, something interesting has happened. The top companies in the stock market have driven all the returns. So of course,
yes, that is very typical of a market cap weighted index. The vast majority of stocks do not over or outperform treasury bills over the long run. Only a very few select stocks do very well in the long run. It is not surprising that we have a few stocks that are carrying the market right now.
Being the contrarian that I am, I thought to myself, yeah, but everything else is going crappy. What does that mean for the overall market? So which led me to find a very, very interesting ETF called the S&P Equal Weight ETF, ticker RSP. Let me show you right now some of the differences. Now, RSP has a higher expense ratio.
Oh my God. That's 7 times, basically 7 times higher than VOO's expense ratio. Okay, let's keep going.
I also do a little more work. Look at this dividend yield, 1.55. Why?
Irrelevant.
It takes every company in the S&P, and every quarter, it readjusts all of its portfolios so that every single company is equal in these portfolios. So it accounts for 0.2% of the portfolio every quarter. Now, the downside to this is when you see these massive jumps in a certain number of stocks, small group of stocks that we've seen from the Magnificent Seven over the last 3 years and other companies, it causes kind of a way of losing out on that gain. Let me show you.
That is false. When stocks go up a lot, it could literally be because the market is repricing the future expectations of that company. Stocks, I mean, sometimes you get clown stocks, right? Like GME or AMC, just clownery that are artificially being pumped up. Those are going to drop eventually. A lot of stocks go up because the market has realized, hey, this company can make a lot more future profits than we initially thought. So we're willing to pay a higher price for this company. That's why a lot of these companies have gone up. Maybe it's not going to come to fruition, but the current market expectation is that these companies that have done very well recently are going to make much higher profits into the future because of AI, my hot guy, okay? It doesn't mean because the stock went up that you can't make money on that stock. That is a fallacy. That is not how you should be investing. You should be a total market agnostic investor, okay? But this approach is an abomination. So we have a net expense ratio of 0.2%. That's 7 times higher than VU, okay? A little bit less than 7 times for you freaks. Dividend yield, irrelevant. Turnover ratio. Turnover is the measure of how much of the portfolio is changing over the years. So basically, what happens is, let's say you have a company, Microsoft, right? I don't know if you heard of Microsoft. And Microsoft suddenly develops this new technology that's going to quintuple the profits of Microsoft. And the market is only just now realizing this. They're pricing it in, and the stock just rips to the moon. What is this ETF going to do, this equal-weighted ETF? It's going to sell Microsoft to rebalance it back to 0.2%. And we're going to compare the holdings in a little bit, just to show you how clownish this is, okay? But we're going to listen to Paul a little bit more.
What the last 3 years have looked like from RSP versus SPY. RSP is here in purple, SPY here. Big.
Yeah, I don't have YouTube Premium. Shut your mouths.
Difference. This doesn't include dividends, by the way, but it's still a big difference.
Why are we pulling up the past performance? It's 100% irrelevant.
Vast outperformance. Why? Because of the Mag 7, basically. The largest companies have driven all of these returns, or a big chunk of these returns.
Yeah, so, if you equal weighted them, you would have less returns. Interesting.
Now, as you all know, back in 2000, the top 5 companies were 15% of the S&P. That was the peak of 2000. Today, the top 5 are 28%.
Well, historically, maybe I'm mistaken here, but in the past, this has definitely been common. Usually a few companies just dominate, and that's fine. If the top 7 companies were 28% of the market cap of VOO, but they were expected to make 28% of all the future profits, that seems reasonable to me. That there's a reason that they're 28%. This is not hard, okay? He's pulling random numbers and he's saying, wow, look at the change. Well, maybe in the past, the top 5 only had, 15% of all the expected future profits. Probably. This is not surprising. This is market cap weighted index fund investing. Some other countries have like one company that dominates and, is a huge part of the total market capitalization. And the reason that's the case is because that company basically makes all the money for all the publicly traded companies. Pretty simple.
Guys, I don't know what's going to happen. Nobody knows what's going to happen. But you see this stat and you think to yourself, wow, is this sustainable? Is it possible that the top companies in the S&P really continue to drive market returns for a long period of time?
Yes, it is possible. Anything is possible.
Maybe. Is it possible? For sure. Is it probable? That's why I have the question. So even though there's a disconnect right here between the equal weight and the regular S&P, I think that's driven for those top 7 stocks. Now,
I'm glad I own them. They're my top 7 holdings. Pretty awesome.
Now, let's go back to when the RSP started from day one. Again, not including dividends. And the dividend seems to be better on RSP versus SPY. This is going back to 2003. You might sit there and go, Paul, it's not that much of a difference. RSP's only outperformed by a little bit. Yeah, that's what the last 3 years, 2.5 time return extra from the S&P versus RSP. And this doesn't include the dividend.
Once again, he shows his lack of understanding of what investing is by pulling up the past performance chart
along the way and reinvesting that dividend. So I look at this thinking to myself, okay, maybe during bear markets, this probably does better. I mean, look at this chart here. Great financial crisis was the first time that they kind of equated out. Then big surge, drop here. So I think the key is, how can you buy it? Maybe you should start adding to it after the big drops in the market. I don't know. But
Oh, just buy the dip of a equal weighted ETF, bro. This is ridiculous. Okay, this is not good. Now let's go look at the holdings. Okay, so this is VOO, which I would recommend if you want to own the S&P 500 in an ETF format. I would look at potentially VOO instead of SPY because it's way cheaper, and I'm a Vanguard shill. So let's look at the top holdings of VOO. Microsoft, 6.95%. Why is Microsoft 6.95%? Well, it's market cap weighted, and that's where Microsoft falls, okay? This is market agnostic. Let's compare Microsoft, which is 6.95%, versus the RSP ETF. 0.21. So you are underweighting Microsoft by like multiple, 30 times? 40 times? You're massively underweighting Microsoft. Why? Because it's got to be equal, bro. It's got to be equal. Look at Apple. 0.21% of this ETF, massive underweight, versus 6.29%. There's a reason for this, okay? This at least makes sense. It's riding along with the market. What does the equal weight do? It basically just says, oh, you got to have 0.2 no matter what. Where's NVIDIA? Seriously? NVIDIA has risen massively over the last year. And potentially for a good reason. Maybe they can sustain their growth and their earnings growth and their deliveries and whatever. Every time NVIDIA goes up, they sell it in this ETF. When NVIDIA, if you'd hold VOO, it's now 6.1% of your holdings. Do you see the problem here? Paul, stop, okay? You're really pissing me off. Everything you do annoys me. You recommend these high expense ratio ETFs. You use flawed logic, and I'm still going to copy you and pick stocks now because that's how you get rich on YouTube. Let's do it, ladies and gentlemen. Cheers!